Hi, everyone. This is Jason Bjork of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She is a global macro all-star, an excellent analyst, one of the best out there in only a couple of years, too, up and coming, probably the best young analyst. And she also has an excellent newsletter. I think she has a free version and a pay version. So we'll let her plug that at the end of the interview. Lyn Alden, thank you for joining me again.
Hey, thanks for having me. I try to just focus on the numbers. I think, most things in life are more about kind of, deliberate growth rather than just longevity of experience. But I definitely, have a lot of people that I learn from. And so I just try to, kind of learn from different experts and then blend it into kind of a data-driven approach that I follow.
Great. And that kind of takes the emotions out of it. So that's important with investing, especially for the long term.
Yeah, definitely.
So I want to ask you about the Fed's balance sheet. The Fed's balance sheet is right now, we're recording this interview on Monday, March 15th, 2021. The Fed's balance sheet is right around 7.6 trillion. And what is your base case for how much it will grow in the next 6 to 12 months or even longer than that, say the Joe Biden administration? Because what's going on now, we're just seeing these really big flashy headline numbers of 1.9 trillion. They're talking about all these other spending programs with infrastructure. It's just pretty fucking nuts. Just dropped an F-bomb there. That shows you how pissed off I am at all this on top of the 3 trillion plus budget deficit. So they're just piling on. It seems like they don't care about deficits anymore. So what is your opinion of the budget deficits and the Fed's balance sheet?
So I try to break it into a couple different buckets that we can expect. And so the baseline is that, they're doing about 120 billion a month. That their last month was higher than that. But so we can call that a minimum of 1.4, 1.5 trillion dollars over the next 12 months. I don't think they're really going to slow that down. And so that's kind of the minimum threshold. So you can go from 7.5 trillion up to upwards of 9 trillion potentially over the next 12 months. The question from there is, what are the different things we can add on to it? And so, for example, we've seen in recent months that treasury yields and other sovereign bonds around the world have gotten somewhat disorderly. We have upcoming questions about the SLR rules, exemption for banks that's set to expire at the end of this month, and that affects how many treasuries they can buy. It's also, of course, going to depend on what Congress does. And so if the Federal Reserve tries to control the long end of the yield curve and does, they have a couple options like Operation Twist or things like that they can do as kind of temporary solutions. But if they do explicit yield curve control, then the balance sheet can explode to the upside because they basically at that point would lose control of the size of their balance sheet in order to maintain yields. It, kind of comes down to what variable they're solving for. And so my base case is that over the next 12 months, a little under 1.5 trillion, it's kind of the low end. And then it goes up from there based on a few options. And we can kind of pencil in certain things. So, we have like a more than $1 trillion baseline deficit. We're doing this $2 trillion stimulus program now. Now they do have about well over $1 trillion in the TGA that they're going to draw down. At least they're planning to. They can actually draw down more than that, but they are planning on leaving a pretty big cash buffer, and so that'll somewhat reduce how many treasuries they have to issue. Now, there's the potential for partial student loan forgiveness, and so that you can pencil that in as somewhere around 400 billion if you go with the Biden plan, which would be a cap of about 10,000. Per student, rather than like the total jubilee that some people in Congress have called for. And then from there, there's a potential for an infrastructure bill. But I think it remains to be seen if that will be able to get through the Senate as easy as this one did, because that's got a lot more moving parts. And so I think we have to get a little bit closer to that in order to kind of start determining probabilities of the timing and the magnitude of that passing.
The attitude here in the DC area, and I've lived here for 20 years now, Republicans and Democrats, the PhD economists around here, deficits don't matter anymore. And I've just heard that mentioned now for months, and it's just gotten louder and louder and louder. But the budget deficits are nuts. The other part of this equation, and you've covered this, is the demand for treasuries. It just seems, and you've covered this, like I said, that foreigners are not buying anywhere near the amount of treasuries, those trade surpluses from China, India, those other countries running massive trade surpluses. And in 2020, China ran a massive trade surplus. India ran a record trade surplus. They're not recycling those into treasuries. So who's going to buy the treasuries then?
So I think a combination of the Federal Reserve and the U.S. banking system, and that's another variable that really affects how much the Federal Reserve themselves have to buy. And so, for example, if you go back and look at the 1940s, which was the only other time where U.S. debt got this high as a percentage of GDP, it wasn't just the Fed buying; it was also basically the U.S. banking system was kind of harnessed into basically being like bags for holding large amounts of treasuries. And so the percentage of the treasuries they held was at record highs back then, both as a percentage of GDP and as a percentage of their assets. And so in recent years, we have seen banks, basically buy a lot of treasuries, but that could really accelerate if the Fed basically uses them as a form of, financial oppression. And Russell Napier, he's an economist that focuses on some of this. And so basically, there's different ways to basically try to control yields. You can just have the Fed, do yield curve control and absorb a lot of treasuries on their balance sheet, or you can harness other institutions and basically, change certain rules and have them, whether it's pensions, whether it's banks, and have them buy more treasuries. And the banking system is kind of one of the biggest pools of capital, as long as they have certain regulations in place that basically stuff them full of treasuries. And so I do think overall, if you go forward 5 years from now, I think a higher percentage of the treasury market will be on the combination of the Fed and commercial banking system. And when it comes to foreign buying, there's kind of two elements to that. So one is there's a cyclical element. And so historically, whenever the dollar gets into a pretty strong cycle, of which there's only been three major dollar cycles in this 50-year period, foreign sector tends to buy fewer treasuries because overall conditions are tighter, and they generally are not buying treasuries hand over fist. And then when the dollar is weaker is when they you start to get more of like an emerging market boom, and that's when a lot of them start kind of buying treasuries. And so we have that. Currently the dollar, even though it went down in 2020, it's still in a relatively stronger band. It hasn't fallen very far, and so overall there's still some tightness there. But then also you have the longer term, more structural change, which is that ever since maybe 7-8 years ago, China decided it was no longer in their best interest to keep accumulating treasuries, and so they've stopped. And then there's really been no kind of marginal buyer kind of come up to the plate since then. And so we've had just overall a pretty weak foreign demand for treasuries over the past 6 years or more.
So do you think the Fed's balance sheet as a percentage of GDP is going to start catching up to the European Central Bank? Because the European Central Bank has the largest total balance sheet in terms of size. I think it's 8.6 trillion now in assets, and I'm using air quotes because they're just subsidizing these budget deficits from the government. They're buying all types of bonds, paying full par value for these things. So do you think then the Fed's balance sheet as a percentage of GDP is going to head towards the ECB's levels as this keeps on going?
I think in the long run, yeah. So basically, the difference with the United States is that we've historically had a lot of foreign demand for the treasuries, and so a larger part of our deficit is externally financed than Japan or the Eurozone. And so basically, the United States is in some ways kind of a weird hybrid of a developed market and an emerging market in terms of how it's financed, because it's the developed market with the global reserve currency. And so unlike Europe, unlike Japan, we have foreign demand for our treasuries. But if this overall trend continues, we look increasingly more and more like those two other developed blocks, in the sense that our institutions, and particularly our central bank and banking system, become the primary financiers of U.S. deficits rather than external sources. And so I do think overall it's going to head in that direction. But over time, they kind of leapfrog each other in terms of the rate that they're going. And so earlier in 2020, the Fed was growing their balance sheet the quickest. And then lately, the Fed has been kind of resistant to kind of moving into controlling the yields in the same way that some other central banks have. And so we've had a little bit of a catch up by the Eurozone and some of these other areas. But I think in time, basically, we'll run into some sort of financial plumbing issue or a credit markets issue, and the Fed will be forced to basically up their balance sheet again. It kind of just keeps going in cycles.
I think what you said earlier in the interview about the US Treasury General Account being drawn down, I think that's like a game that's being played to delay this explosion in the size of the Fed's balance sheet. They're trying to delay it as much as possible. So where it's only growing maybe every month or two, like 100 billion here or 200 billion there, it's not growing 200 billion per month, because then that will really rile markets. They're trying to, I think, make sure, Lyn, that they're trying to keep the dollar index in a trading range, because there's been calls on both sides. Peter Schiff, he's a big dollar bear, and then Brent Johnson, he's calling for this big dollar super spike. It almost happened early in 2020, in February and March 2020, before the dollar index got hammered back down. But ultimately, the dollar index has been in a range for about 6 years now. So do you expect that to mostly continue for a while?
So overall, yes, I think it has like a flat to down bias at this point. And so I think, for example, the milkshake theory was valid up to about mid 2019, when they had to stop, the rate hikes and start cutting rates, and then so it started to relieve. But then you had basically the climax to it happen in early 2020 with the virus and the shutdowns and everything. And so overall, I do think it's on somewhat of a more structural down leg now, similar to the early 2000s that we had in kind of the last dollar bear market, but it never goes in a straight line. And so we had a bit of a counter rally in the autumn, and we're in another counter rally now, which is normal because it started to become a consensus trade. And so people, after it went down pretty far in 2020, even though it's like you point out, it's still range bound, a lot of people got kind of piled on. And so right now it's kind of correcting to the upside, and it's largely going to depend on, I think, what happens with yields this summer. And so if the Fed moves to control yields, I think that's when we get another down leg in the dollar. And until they do that, I think it's somewhat likely to continue to be range bound. I've been telling my subscribers that while it's between 88 and a little over 92, it's not that interesting. It really kind of has to have a breakout or a breakdown outside of that particularly tight range in order to get interesting again.
How quickly is the US Treasury General Account being drawn down right now? So that $1 trillion you mentioned, is that going to be used up in 6 months, a year? How quickly? What type of pace is the drawdown occurring right now?
It partially depends on what the Treasury does. And so, for example, this was built under Mnuchin, and now it's being drawn down under Yellen. And if you're watching, the Treasury every quarter says how much net issuance they plan to do, and it's not like they can change it during the quarter if they find out that they need different financing needs, especially because, for example, they can't predict ahead of time what Congress is going to pass during that quarter, and they can just kind of change their mind. And so, for example, last year the Treasury kept saying, okay, we're gonna issue this much, and then by the end of the quarter, we expect to have this much in the TGA, and they kept overshooting it. They kept basically building it up and then keeping it higher for longer than they were kind of saying they will. And then under Yellen, they revised that and they said, okay, we're actually going to issue a lot less treasuries than we said we would for this quarter, and so we're going to start drawing down the TGA. And this time, it seems like they're more intent on it. And so it did start to draw down. I mean, it hit a peak of like 1.8 trillion. It's already down to less than 1.4 trillion. But I think that the real kind of decline is we're probably in the heart of it now. So I would expect it to be pretty far down in the next 3 to 6 months. And then I think it'll remain elevated. I mean, they basically used to have a practice of not really having this account. In recent years, they generally try to keep it around 400 billion. And I think now, they might aim for 500 or 600 billion. But basically, they still, at this point, they have the better part of $1 trillion that they're going to draw down. And so I think that's probably going to be pretty quickly. But we could always get curveballs from the Treasury and say, actually, we're going to issue more treasuries than we thought, and that would basically delay it from going down.
Yeah, I think there's two main problems here that are not going to go away no matter what types of games the Fed tries with either Operation Twist or yield curve control, and that is the sheer size of the budget deficits and then the lack of foreign demand for treasuries. And those are the two main problems. The Fed and the Treasury are just trying to rack their brains coming up with short-term solutions, but there's not a real long-term solution in play.
Yeah, and also, I mean, I one thing I've been pointing out is that the Fed is somewhat of a reactive organization. And so basically, they just let things play out until something breaks, and then they put out the fire. they don't try to rush ahead and put out fires before they start. And so kind of like how in 2018, they're hiking interest rates. They said the balance sheet reductions on autopilot. Then the market freaked out, and everybody focused on the S&P 500 going down, but really it was credit markets freezing up that probably forced them to change their direction there, and suddenly become quote data dependent, the famous Powell pivot. And then similarly, they were still reducing the balance sheet until they had the repo spike, and then they had to start buying T-bills. And so I think we're in a similar situation now where they're going to try to stay on roughly their same course. And if something breaks, that's when you can get another kind of a surprise move to the upside in some of their purchases. And they already have left themselves some leeway. And so they have language instead of saying an exact amount they're going to buy a month, they say at least. And so basically at least $120 billion a month. And so they have a kind of a multi-tens billion-dollar wiggle room there. If they buy 150 billion, it's not really going to cause much of an eyebrow. But if they go, like I think you said, over 200 billion, that's when the markets can really kind of notice that. And so they have been very, very smooth with their treasury purchases over the past several months. And so I think that's something to watch. Basically, the TGA drawdown does give them a lot of time, and then it kind of remains to be seen what will happen from there. I think, especially if you pass that massive infrastructure bill, that's when you almost certainly would have to have the Fed kind of step up and buy more treasuries, just because there wouldn't really be other demand sources for that size of an issuance.
And the Fed recently, in the last month or so, has really stepped up their mortgage-backed security purchasing. I think it went from 30 billion a month, and now it's a lot more than that. The hedge fund managers I'm talking to are starting to expect a big real estate crisis, I guess, commercial and maybe residential, with the forbearances and all the other games that have been playing with the eviction freezes and the forbearances coming up. So it looks like the Fed's going to have to start buying a lot more of those things as well.
Yeah, it's possible. I mean, so far, basically, as the long end of the curve, as that starts the treasury curve, as that starts to go up, the one of the more sensitive thing that pressures is the real estate market, because it puts upward pressure on the mortgage rates. And so, this the whole system of really high real estate prices, really high asset prices in general, is really kind of predicated on those really low interest rates. And so as those interest rates rise, the servicing costs of being able to afford those high end homes and things like that become very unmanageable for a lot of people. And so basically those rates eventually are the things that could slow down this like cyclical upturn we've had. And so basically the Fed is kind of choosing between trying to maximize employment and also do price stability. And there are times in history where they basically completely sacrifice on one, like in the 1940s, for example. They basically totally, gave up on inflation for about a decade, and just really focused on the war effort. And so I think probably in some point in the 2020s, they're going to let inflation run hotter than people think, in order to kind of basically keep the wheels on the cart.
The real estate market around where I live is totally distorted. My best friend's a successful real estate agent here in the area, and the rent prices have collapsed for months now. They're down a lot, but home prices are soaring, and there's all cash buyers coming in, and there's bidding wars. People paying $50,000 or more in a bidding war. Houses that hit the market are sold 3, 4, or 5 days later, all cash bidding war.
Yeah, it's nuts out there.
Oh, it's an insane distortion. It's not making any rational sense, but I think that's because of Fed intervention and government intervention.
Well, we have 7- and 8-figure NFTs being sold, so everything in perspective.
We'll talk about the crazy stock market casino and all that in a second. But first, I want to get your opinion, since we were talking about the treasuries, balance sheets of the central bank. The central bank that was doing this before anyone else was Japan, the Bank of Japan, Japanification. So I get asked this question a lot. What's your definition then of Japanification and what the Bank of Japan did with their balance sheet and yield curve control? Could you explain that so the average listener who's more of a beginner to this can understand it?
Sure, and I had a whole article on Japan recently, because it is a widely misunderstood thing. And so basically what Japan did was they had the bubble of all bubbles in the late 80s and the early 90s, Basically, it's like if you had a stock market bubble that was twice as big as the dot-com bubble, and then you also had a real estate bubble that was multiple times larger than the 2005, 6, and 7 U.S. Subprime mortgage crisis, and you had them both happen at the same time. That's basically what Japan had in the late 1980s, and so that was the bubble of all bubbles. At the same time as their population started to go sideways, and so as that unwound over several decades, 3 decades now, there basically was a giant transfer of debt from the private sector to the public sector. And so the central bank started ramping up their balance sheet to well over 100% of their GDP. They became the huge buyer of government debt. And even just going as far as buying ETFs, so they own a big chunk of the Japanese stock market as well. However, that was offset by corporate deleveraging and to some extent household deleveraging. And so if you look at their corporate sector, it's still fairly highly indebted, but it was a kind of a long decline over the past 20 years of reducing corporate balance sheets. And so we've had this situation where the money supply actually did not grow very significantly in Japan. And so the M2 rate grew at a much slower pace than the United States and the Eurozone. And then even if you adjust that per capita, they also grew at a very slow rate. And so, for example, M2 in Japan grew at like a 2.9% per capita rate over the past 20 years, whereas for the United States, it was far more than double that. And so people often use Japan as a case, and they say, okay, look how much you can print without getting high inflation. But there's a couple issues with that, because what Japan did over the past several decades was a mix of deficit monetization and private sector deleveraging. And so the overall result was stagnation, and you had high real estate prices. Stock market, once they started really ramping up their balance sheet from like 2012 and onward, their stock market went up a ton. And so overall, it's somewhat of a different situation because they have a structural current account surplus. And so they basically, instead of running a deficit like the United States does, they run a structural current account surplus. They have a positive net international investment position, meaning they own more foreign assets than foreigners own of their assets. And so basically you have a combination of a very, very slow growing economy, pretty much a stagnant sideways GDP, very high leverage, but kind of a very kind of stable system. And that current account provides somewhat of a floor for their currency compared to some of the currency pairs they trade against. And so the yen didn't really devalue over the past 30 years compared to the dollar because they have these different competing forces. And so what the United States is going through now is somewhat different than what Japan went through, because we're running much larger deficits and we're not really doing any corporate deleveraging. And so our money supply is growing a lot quicker than pretty much any time since the 1940s, and pretty much not comparable to any other thing we've seen in any developed market over the past several decades.
And I think Japan's a unique case study due to their culture and also the way their economy was run, because they largely run trade surpluses. Their population has a high savings rate. So they were able to subsidize a lot of those Japanese government bond purchases. The population bought a lot of those. The pension funds bought a lot of those Japanese government bonds, but in addition to the central bank also buying them. Plus, they were buying with their trade surpluses US Treasury. So they were adding enormous amounts of reserves too. So that prevented their currency from collapsing.
Yeah, they also, there's a couple other things. One is, they did run very big fiscal deficits, but prior to the pandemic 2020, their biggest fiscal deficit was something like a little over 8% of GDP in a year. And so while that's big, and they did that multiple years, there was nothing in Japan like we're seeing now with 15 or 20% deficits like we're seeing in the United States today. Another thing about Japan is that they have very, very low military spending as a percentage of GDP. And they also, despite the fact that they're one of the oldest countries in the world, they have very low per capita healthcare costs. And so overall, a lot of their government deficits get recycled back into the domestic economy. And so overall, they've been quite efficient despite being so stagnant. And so they've really kind of managed to keep that surprisingly stable given, the distortions that they're causing.
And now you have the European Central Bank and the Federal Reserve trying to copy similar policies to the Bank of Japan, but their economy is structurally different, as you've outlined. Plus, the budget deficits in terms of just sheer size are much larger, and there's even more social program stuff being given out in both the European Union and the US.
Yeah, there's a couple. So there's kind of like those three groups, and the Eurozone in some ways is closer to Japan in the sense that their fiscal deficits are much smaller than the United States. They don't pay a lot of money for their military. They have a somewhat lower per capita healthcare costs, so they're generally a little bit higher than Japan, but not as high as the United States. But their main issue is because they're a monetary union without a fiscal union. There's a lot of distortions between the different countries. So overall, it's a very unusual environment. They actually have a larger current account surplus than Japan. But they basically have a lot more kind of structural issues in the Eurozone itself. And so I think in some ways they could head towards the Japanese route more readily than the US in terms of, having stagnation, but then not having the currency fall apart any quicker, at least, than the dollar. But there's always tail risk with Europe, right? So unlike Japan, which is surprisingly stable, the thing you have to watch out with Europe is that, if Italy, for example, decides to leave the European Union or specifically the Eurozone, that's a whole kind of massive process to go through. I mean, we saw, for example, Brexit play out, and they at least never tied their currencies together. And so that is, as messy as that was, imagine going through that with your currency totally intertwined with the entity that you're leaving. And so that kind of has that, potential time bomb in there to keep watching.
I want to transition now to China because we've talked about the US, we've talked about Japan and Japanification, we've talked a little bit about the European Union. So the other major economy to pay attention to is China. And I've never really heard you talk about the problems in the Chinese economy. Normally you talk about commodities bull markets. So what are your views on what China has done to kind of deal with the pandemic and the spending programs? Because most people aren't aware of this, including financial professionals. In 2020, everyone talks about the US's M1 and M2, how rapidly they're growing. But China's M1 and M2 actually outgrew in terms of percentage the US's M1 and M2 in 2020. And then China, on top of that, has a corporate bond bubble inside China as well. And there's massive amounts of defaults. So yes, China's running trade surpluses, but they also have these big issues with their corporations and bond defaults.
So there's a couple ways to look at it. If you look at it in absolute growth, they did have a very significant M2 money supply growth in 2020. But for example, their year-over-year percent change for M2 was about 10% compared to about 25% for the United States. The biggest concern I have with China is their real estate market, the valuations and the amount of leverage. And so if you kind of separate household debt, public debt, and corporate debt, the big area for China that's an issue is corporate debt. And so if you add them all up together and compare the United States to China, they both have similar overall debt to GDP figures. But with the United States, it's kind of balanced out between those three buckets somewhat evenly. Now increasingly since 2020, more and more on the federal side. Whereas China, it's very concentrated in their corporate sector, and specifically in that area, a lot of it's heavily tied to their very expensive real estate market. And so overall, I personally avoid any investments related to Chinese real estate because it's kind of a black box, right? So you're relying on reporting that is not as strong, obviously, as other countries, and you're dealing with a very leveraged shadow banking system. And so overall, that's something I am very cautious of. I invest in a handful of Chinese companies, but it's something that I always make the position sizes smaller than I otherwise would, because you have a higher risk of accounting issues, and you have higher risk of just overall kind of jurisdictional issues compared to some other markets. So I factored into a portfolio, but with caution.
I'll take Jim Rogers' advice. He wrote an entire book about this. He said, and he's repeated this for years now in interviews, the best way, safest way for the retail investor to have exposure to China is not through Chinese companies because of the accounting fraud and other issues, like you said, with lack of private property rights for foreigners and how the rules can be changed by the Chinese government. It's with exposure to commodities and buying those commodities that are out of favor and buying them low and selling them high. So trying to be a contrarian and hoping that you just average into positions, when oil was in the low 30s or when copper was down to $2.20, $2.30 a pound. Those are opportunities that you accumulate wealth.
Yeah, absolutely. And commodities have been a pretty big segment of my portfolio. And I do rotate it over time, like you said, based in a somewhat contrarian fashion. Like commodities that are really suffering tend to be the more interesting ones, whereas commodities that start to get kind of hot are ones that I start to scale out of somewhat. And so the good thing about the commodities segment is that it's not just dependent on China, even though that's the largest factor now. There's also kind of the potential growth from India over the next decade. And then it's also looking at the supply side. And so there are some commodity bull markets that are driven by the demand side, and there are other commodity bull markets that are driven by the supply side. Basically, commodities are a great diversifier in a portfolio, and it's something I've been focusing pretty heavily on in the past couple of years.
So do you think then that China has put the majority of their trade surpluses into stockpiling commodities like food, energy, industrial metals, rather than actually buying US Treasuries now?
Well, it partly is commodities, but then it's also investing in infrastructure and commodity producers. And so it's basically buying commodity rights and making loans to a lot of frontier markets or other emerging markets that if those loans are defaulted on, China gets the asset. So whether it's a port or some other infrastructure, that the default results in them getting the asset. And so that includes commodity production and infrastructure. And so it's kind of that big mix. And so in some ways, instead of just investing their surpluses back into buying U.S. government debt, it's been buying different types of debt around the world that is more linked to real assets.
Yeah, that's debt diplomacy. I mean, the US did that too, and European colonialism did versions of that as well. So unfortunately, history is repeating. But in terms of the commodities bull market that has gone on now for the last 6 or 7 months, do you find this unusual from a historical standpoint? Because when I've studied commodities bull markets and looked at the ones for the last 30 years, the ones that occurred either in the late 1990s, early 2000s, when China joined the World Trade Organization, or in 2009, when China just spent like crazy on their stimulus program. I think it was 40 or 50% of their GDP. They put trillions in for their infrastructure and spending. And from 2009 to 2011 or 12, the commodities prices just absolutely exploded. Normally, gold and silver led the way up and the other commodities followed. But really, since the first week of September, we have not had a traditional commodities bull market. The gold price has lagged a lot. The gold price is down significantly, big correction, while the other commodities, especially food, energy, industrial metals, those ones have outperformed. Is this unusual from a historical standpoint?
It depends on what metrics you're looking at. And so one way I'm characterizing this is more of a supply-driven bull market than a demand-driven bull market for a diversified commodity basket. If you focus on, I like to focus on the copper to gold ratio to some extent. And so what we saw, if you look at over the past several decades, gold, that ratio hit basically tied for an all-time low around that March and April area, meaning that gold basically reached an all-time high compared to copper during that period. And so basically, if you look at, gold really rallied from 2018 up through that mid-2020 period. And that's when we had a period of a much slower economy globally, and we also saw real yields fall from positive 1% down to negative 1%, and so that was because you had slowing economic growth, and then you had both official CPI falling, but then you also had Treasury yields, U.S. 10-year Treasury yields falling faster than inflation. And so that's when you went from a positive 1% down to a negative 1% real yield. And historically, gold's strongest correlation is with real yields of the 10-year Treasury, and it has that inverse correlation. And so during that economic stagnation, we saw really strong performance of gold and gold miners and gold royalty companies. And then starting in that kind of that April time frame, we started to see these other commodities break out. And that's, of course, when we saw the massive stimulus kick in, the response to the pandemic. And so if you actually look at the copper to gold ratio over 3 decades, it's been in this really tight range. It keeps bouncing back and forth with a mild trend. And the only time it really kind of broke out from there is when copper soared in the 2006 2007 period, due to China. But if you kind of factor that little bubble out, it's been a surprisingly clockwork range-bound motion every couple of years. And so after hitting a bottom in April, it's shot back up as copper really outperformed. And right now it's right on the upper end of that range. And so, earlier this summer, I was more interested, I kind of rotated a little bit. I still held my gold, but I also rotated, somewhat towards these other commodities. And now that gold has done so poorly, I'm actually getting somewhat interested in gold again because, this ratio is kind of stretched again.
Well, also the paper price of gold is much different than actually getting your hands on an ounce of gold. It was 12% premiums to spot price for a physical ounce of gold for an American gold eagle. So, I mean, the premiums are very high. Just because the paper price is down a lot does not mean you can go out and buy an ounce of gold at the around $1,700 or $1,730 when we're recording this interview.
Exactly, yeah, and that also happened during the March sell-off, 2020 of last year. Basically, when we had that kind of the liquidity shock, and so whenever there's a liquidity shock, I mean everything gets sold. So, even gold was sold, but the physical gold wasn't being sold, and so we saw massive differences between gold, silver, and platinum coins, if you can get them at all. I mean, for the most part, you couldn't get them at all. If you could get them, they were at absolutely huge premiums. And so, there are ways in the public markets to kind of mess around with that. And so, for example, the Sprott funds are some of the closest thing you'll get to, kind of real metal. And so you could kind of arbitrage that difference and kind of use that to reflect that probably you'll get a bounce back in the paper market, which we ended up seeing from those March lows. And so I do think we're in an environment now where it is getting a little bit interesting again, where the paper market has been so bearish. But the overall fundamentals for it are still good, and we're getting back towards the top end of this kind of copper to gold ratio, and so overall I do think that that's a little bit stretched now, and I think gold's it's totally out of favor, and so I still like it here combined with kind of a diverse basket of commodities. And so my overall play here, I mean, I have gold, I have silver. I've been heavily invested in copper producers, although I've just been scaling out of them. I like uranium. I like Bitcoin. I like, basically a diverse set of assets so that I'm not kind of overly concentrated in any given one, because they kind of take turns outperforming.
I'm also a big natural gas bull long term because the energy transition switch, even if more electric vehicles are used, they're still going to be required for a lot of those. Even if they go to hydrogen fuel cells or something else, that's still going to be largely hydrogen powered.
Yeah, I agree.
Natural gas powered.
Yeah, so I like natural gas transporters, for example, and I still like certain oil and gas producers, and I really scaled into them this summer, and I still hold a lot of them. I mean, they have gone up pretty significantly, but if you look at their long-term performance, it's been pretty dreadful, and so overall, even though they've done well in this cycle, I'm still pretty bullish on a lot of them long-term. Because a lot of people talk about electricity as a form of energy, but all it is a transfer of energy. And so basically, if you shift more towards electric vehicles and away towards gasoline vehicles, that just means more energy goes over the grid. And so basically, depending on where you look, I mean, in Asia, that's largely coal-based still. And in North America and Europe, it's heavily natural gas and nuclear plays a role. And so overall, I'm just bullish on a pretty broad section of commodities, especially anything related to the grid. So I was pretty bullish on copper until we got this really, really strong move, and I'm still bullish on copper. I think we've gone pretty far, pretty fast. But then I also like uranium because I think, we're going to see continued build out of that in Asia. I also think there's a pretty clear supply issue building in the next several years, and so I do think that some of these, I think there's kind of been of a bubble in electric vehicle stocks, and so my preferred way to play that trend has been through the commodities rather than the bubble stocks.
Yeah, I agree. Those valuations are ridiculous on those electric vehicle companies. And then there's all these SPACs now about those too. I call it SPAC madness.
Yeah, I mean, if you can kind of crunch the numbers and say, okay, I mean, Tesla's sold off now, but I mean, during its peak, it was like as expensive as like all car makers combined, pretty much. And they were selling a tiny fraction of the number of cars that Toyota sells. And so even if you say, okay, let's say you're wildly bullish on Tesla, the company, and you say, okay, they're gonna one day sell 20 million cars a year. uh, you know, I say, okay, that's great. I'll buy the resources because Tesla's already priced so that it'll one day sell millions and tens of millions of cars. And so even if it does eventually grow into that valuation, however many years in the future, that's still a big if. But say they do, or say the whole industry does, the resources for that are not really pricing that in, whereas the stocks more than price that in. And so that's why I was like, okay, I'll just invest in the copper, I'll invest in the silver, I'll invest in the nickel,
It's
I'll invest.
cheaper and you
Yeah,
still get exposure. Yeah. So like any of those companies that are going to be building out the infrastructure for supercharging stations for electric vehicles, or the actual materials, so the energy usage or the wiring, those ones would be, because that's the infrastructure that needs to get built, rather than betting on a specific electric vehicle company, because the odds are, I mean, Tesla has been in business so long and they're not consistently profitable. I think they made more money on their Bitcoin trades recently than they have in the history of total profits of actually manufacturing electric vehicles.
yeah, they did. Yeah, because they've historically not had an accounting profit, and last year I think they had a very minor accounting profit when you take into account credits and things like that. Whereas they made more from their Bitcoin offering than all their profits combined. But really, the bulk of their cash comes from selling their stock. And so they basically, they raise equity by doing shares. And so the funny thing is they kind of memed themselves into solvency. And so, if you look at where Tesla was a couple of years ago, the balance sheet was looking kind of bad. Their debt was I don't know the current rating, but it's actually like a junk rated security. And back then it certainly deserved that. Because you look at their debts, you look at their cash, you looked at how tight their operation was. It didn't look great in terms of a credit risk, but because their stock got so expensive, they were able to issue equity at extraordinarily high valuations, and it ironically, it filled them up with cash. It basically, made them a much more solvent company, even though I still think they're radically overvalued. And so it's like they memed themselves into solvency, which is really funny to see.
There's so many unprofitable technology companies that barely have revenue growth. So they're not even talking about fundamentals anymore. No one talks about earnings, free cash flow, profit margins with a lot of these technology companies. The Securities and Exchange Commission just put out a warning about celebrity endorsements for these special purpose acquisition companies or SPACs, SPAC madness. Now you have the NFTs, these non-fungible tokens that all these celebrities are trying to put their name onto. It reminds me of the 2017 initial coin offering bubble that it was cracked down on, but people didn't go to prison. I think there was just fines where SEC fines where people didn't admit guilt. Where are we in terms of like stock market mania, the casino, and valuations? Are we at the most ridiculous valuations ever, or top three?
But I think top three. It also depends on where you're looking. And so, in terms of the dot-com bubble was special because what made that one so crazy was that treasury yields were like 6%, and yet stocks still managed to get that expensive. And so when you looked at the equity risk premium of, say, the cyclically adjusted earnings yield of the S&P 500 compared to treasuries, that was the worst it ever was. Whereas now the problem is that the treasury market, is basically until recently it was the most expensive it ever was. If you basically did instead of the yield of the treasury, if you did the PE ratio of the treasury, so basically flip it around, you were looking at like a price to earnings ratio of like 200 for the 10-year Treasury back in mid 2020, when you have like a 0.5% yield, and so investors were like looking at that and then saying, okay, or I can look at stocks, and so basically everything got very expensive. Now we've had some of a rotation, so as 10-year Treasury started to rise, and the longer end of the curve started to rise, we've had a cooling off of some of those high-flying growth stocks, and we've had a little bit of a resurgence of value stocks. But then, of course, we have these games being played with short squeezes and kind of speculative option activity. And so, if you look at the overall ratio of options and the amount of retail participation in the options market, that looks a lot like the 2000s. And so, overall, I think that there are very big bubbles, but they're it's not like the entire market is the same level of a bubble. Like there are, I think the EV space and some of those really speculative ones are like they're basically the equivalent of a dot-com bubble, but then you have other areas of the market that are historically kind of average price, and that's actually kind of the same thing you saw in the dot-com bubble. So if you looked at real estate investment trusts during 2000, they weren't silly. They were actually normally priced. And so, for example, now there are parts of the market that are still kind of boring, like some healthcare stocks or gold stocks or certain types of equities that are still kind of priced like they always are. But then you have other segments of the market that are just kind of completely detached from fundamentals.
So just more distortions from the central banks.
Yeah, it's one of those things where if money has no time value, then asset bubbles are more likely to form. And so, the asset bubbles can still form when money has a time value. Like again, in 2000, that's kind of what made that one remarkable. But when money has little time value, it just encourages asset bubbles. It's kind of a policy that promotes asset bubbles.
Plus, there's a record number of unprofitable technology companies that are going IPO now, or with these SPACs, special purpose acquisition companies, being dumped onto retail investors. So there's so many of these companies with record valuations and no profits. They used to be called a unicorn, I think, if their valuation was over $1 billion and they had no profits and they were a tech company. But now there's so many of them, you can't even call them a unicorn anymore.
Yeah, now there's like a deck of unicorns. And yeah, basically a unicorn was $1 billion private company. Some of them are profitable, most of them weren't. And now you have companies that are worth, almost 100 billion before they even go public. And so Coinbase or Stripe, for example.
It's insane. It's very similar listening to the people that were around during the tech bubble, but it's on another order of magnitude because of what the central banks are doing. And there wasn't professional sports for a while because of the pandemic. So you had all these people that used to bet on pro sports and they were at home. There was no pro sports to watch or to gamble on. So they just went into the stock market then instead with call options, the Davey Day Trader Global, Dave Portnoy.
Yeah, and I think the rising yields is the key thing to watch that is kind of putting some pressure on these bubble, and that's why we've seen, if you look back since the late autumn when we got the vaccine announcements, and then we got yields started ticking high pretty quickly. We've seen some of a rotation where some of those bubble growth stocks started weakening. We started to see an uptick in value stocks, and it's like most things, like some of that rotation made sense. And so, for example, a lot of those value stocks were oversold and started to come back to life, like some of the energy stocks, for example. But then you saw a lot of these other companies become memes, and so basically it became popular to buy these almost bankrupt companies and just basically push them up. And it's kind of like the hedge funds play those games anyway. Now it's just being played by retail market as well. And so I think we're getting towards the later phase of this because the overall kind of direct stimulus checks might be behind us for a while because now they're gonna focus on infrastructure and things like that. And then also the rising yields just puts pressure on this. And so we'll see what happens with yield curve control or other things like that. But as long as we're in this current environment of yields going up, we're actually seeing some of the tech stocks still be somewhat pressured.
And anecdotally, some of the stories I've heard, or people even messaging me. I mean, an Instagram fitness model messaged me, slipped into my direct messages. She didn't know anything about the stock market, but was bragging about how much money her and her friends were making doing stock options trading. So, and we're seeing posts on this all over, TikTok, Snapchat, Instagram, and these people have little to zero knowledge of the actual stock market. So any fundamentals, and they don't understand risk and the downside. So this is not going to end well. I don't want to put a time on when the shit's going to hit the fan, but it's not going to go on forever like this.
I agree.
It's just crazy though. Like just seeing people, post screenshots like, oh, I made an extra $2,000 easy trading stock options. And then how much do you know about the stock market? Oh, I don't know anything. We just discussed this on, a Discord chat board about which stocks to buy, which options to buy or which stocks. That's it. That was it. And then they went and gambled.
Yeah.
Unbelievable. Okay, well, I have one more question here before I let you go. This has been an amazing interview. My listeners are going to love this. Can't let you go without asking you about what signs you think that gold is going to bottom. So in my opinion, I think one of the major reasons why, besides the yields that you said and the pre-programmed hedge fund traders, when the yields rise, they automatically sell off gold. And then that just feeds on itself with a vicious cycle of selling with the downtrend. But the other major thing is the Fed's balance sheet. I think the gold price in dollars is heavily correlated to the Fed's balance sheet growth. And really for the last 7 or 8 months, the Fed's balance sheet hasn't really grown that much. So I think it's only grown, a couple $100 billion. So there hasn't been this explosion yet of the Fed's balance sheet. So do you think that correlation is going to take hold again once the Fed's balance sheet goes to 8 trillion, 9 trillion, that the gold price will bottom? Or what signs then do we need to see that gold will have finally fully bottomed then, in your opinion, and this short little bear market is over?
I think the most telling thing to watch would be real yields. That is by far its strongest correlation, and we've actually seen it in the past couple weeks here in kind of the first half of March. We have seen potential signs of a bottom where you've had even though Treasury yields are still rising. The real yields have actually kind of gone sideways for the past couple of weeks, and we saw gold touch down and then kind of bounce, and then it's not really doing much, and so that is a potential bottom, but it's not really confirmed yet. But it's something to watch. I think it's showing signs that it is kind of in the early stage of potentially being a bottom, and there are a couple catalysts to watch. And so one is the TGA drawdown. Is just kind of like a liquidity bazooka kind of coming back to the market. We're also seeing the stimulus checks go out. We're seeing vaccines go out. And if you look at year over year, headline CPI, it's funny how much people place on that number, but a lot of participants watch that number. And so it's almost like you have to watch that number because other people are watching that number. And so the algorithms are watching that number, different funds are watching that number. And a lot of people were disappointed that the February CPI was not very high, which was reported, last week here in March. But if you look at base effects, I mean, that was pretty much expected. The part of the year where some of the headline CPI numbers are going to get somewhat high is in April and May, which are reported in May and June, respectively. And that's because if you look at the CPI, it had a dip pretty significant in March, and then it hit a bottom in April and May, and then it started trending up a little bit. And so basically, because you had that somewhat temporary disinflationary shock from the shutdowns, the year-over-year numbers for April and May there's a good chance they're going to be over 3% headline CPI. And so that can basically help drive real yields up potentially. Now, it partially is going to depend on what nominal yields do. And so the overall, kind of the rocket fuel end game for gold would be yield curve control. Whereas if inflation goes up to 2, 3, 4, 5%, headline CPI, while the Fed basically holds yields at, 2% or 2.5% or something like that, then you can get negative yields that are deeper than the negative 1%. That they reached back in mid 2020, they're negative real yields, and so that would pretty much be the big upward move for gold if you were to get that. And so there's basically a couple things I'm watching. I want to see what they do with the SLR rules extension. I want to see what happens with some of these headline CPI prints in late spring. But for now, I'm watching those things, and I'm also watching what real yields are doing.
What is the SLR extension for listeners who are not familiar?
So last year, during it's actually basically to protect the treasury market in many ways. So the treasury started selling off because foreigners were selling treasuries, and so the Fed had to come in and buy $1 trillion of treasuries in 3 weeks, and then they kept buying treasuries. And one thing that they did was that they temporarily suspended a leverage ratio for banks, the supplemental leverage ratio. And basically that let banks not count treasuries and reserves as their leverage when they're basically figuring out how much things they can buy. And so that allowed them to buy more treasuries. And that's set to expire here at the end of March. And so basically that would go back to the old rule, which potentially means that banks are buying fewer treasuries. And so we already have rising yields, and the Feds, they're trying to stick to buying a certain amount, and then you potentially have the banks not buying much. That could result in bond market volatility, kind of a disorderly move in treasury yields. And so we're going to see if the Fed, kind of steps in and extends that, or if the Fed has to come in and just buy more treasuries.
And those yields spiking and the Fed trying to do games either with Operation Twist. Well, Operation Twist won't expand the balance sheet massively. That would just be buying long end treasuries instead of the short-term treasuries that the Fed normally buys. But the Fed is buying all kinds of things now, including treasury inflation protected securities. There's a big spike in mortgage-backed securities. But the Fed's going to have to, the Fed's balance sheet is going to have to, if they're going to try to control yields, yield curve control, and kind of similarly copy Japan, they're going to have to drastically expand that balance sheet.
Yep. And so that if they do kind of shift in that direction, that could be the next leg up for gold.
So we'll see how soon that happens. If it's a couple months, if they draw down the Treasury General Account, though, that will delay the balance sheet going to 8 trillion, 9 trillion, 10 trillion by at least like 4 to 6 months, though.
Yeah, I think right now they're sticking on their current approach, and so at their current rates, it wouldn't get to 9 trillion for about a year. So if at any point you say 6 months from now they have to accelerate that, that gets interesting. And so we have a couple catalysts to watch out for. One is what happens with the SLR rule extension here, either this week or next. Then we're going to see what happens with the headline CPI prints in April or May, which could surprise some people that aren't looking at base effects properly. And then also, we'll see what happens as this progresses, when there's not necessarily a lot of these big demand sources for treasuries, compared to the supply that's being given out. And so there's some buyers around the margins. If yields get high enough, it can attract a little bit of foreign buying. But when you're talking about this many trillions, there's just not really the balance sheet capacity to absorb that, other than the Fed and the banking system.
And if the Fed's balance sheet gets to 9 trillion or 10 trillion, I would be pretty surprised if gold's not out of this downtrend on the paper price and at least heading towards 2,000. It might even be over heading towards 2,000. It might even be over $2,000 an ounce by then.
Yeah, it's quite possible. And I think that's certainly one of the variables to watch. But yeah, for me, it's real yields is by far the strongest correlation. And so if that's happening while nominal yields are continuing to rise sharply, that could keep gold somewhat contained. But the rocket fuel happens if the balance sheet's going up a lot and yields are being suppressed either with Operation Twist or yield curve control, and you get some big headline CPI prints. That's when gold can, really soar.
But Uncle Sam can't afford those interest payments on the debt rising, right? What are every 1% increase on the national debt now that it's over 20 trillion is what, an extra 280 billion or something like that. It's pretty nuts. 1% increase in interest rates is insane for interest payments on the national debt. Yeah,
I mean, as a round number, after the Treasury issuance that'll happen this year, we'll have 30 trillion in debt, round number, and so every 1% of that is 300 billion. Now it's a little bit tricky because they can change their Treasury duration profile, and so for example, the Fed's holding yields at zero. And so the short end of the Treasury curve is virtually zero, whereas the long end of the Treasury curve is where you're starting to get rising rates. And so one thing that the government can do in order to keep its interest costs low is they can reduce the average duration of their treasuries and basically issue more T-bills and T-notes. And that would keep their funding costs from rising too much, even if 10-year, 20-year, 30-year bonds, their yields keep going up. However, then they take on interest rate risk. And so if they ever do raise short-end interest rates, all that has to be rolled over pretty significantly. And so there's kind of different ways to do yield curve control. One is you can cap the whole curve like you did in the 1940s. The second way is you can basically keep the front end pinned at zero, let the long end rise somewhat, and that would reduce some of the bubbles, but it also forces the federal government to reduce its treasury duration, which I don't think they want. And so I kind of think we're heading towards some bottlenecks here.
I think ultimately they're going to have to buy a lot more of all these different duration treasuries. Unless the budget deficits shrink in size, I don't really see that happening, though, based on what I know here in the DC metro area.
Yeah, I think it's unlikely, especially when you have a divided Congress, it's hard for them to agree on things. And so because the Senate is so tight, I think getting tax increases through to offset some of the spending that they're doing is unlikely. And so it's kind of like you're getting the spending without the tax. And so that translates into deficits. And so that's kind of how I'm seeing it.
Well, also to add to your points there, before the next congressional election in 2 years, they're trying to ram every single spending package across. So they're trying to get everything they can rammed in the next 2 years before the next election. Yeah,
and that's why. So my overall roadmap, I do think that the partial student loan forgiveness is somewhat probable. So I'm on the lookout for that, especially because I don't know if you saw this recent bill. One of the Easter eggs in there was that they made student loan forgiveness like not taxable, because if loans are forgiven, that's considered a taxable event, and so they basically removed that for a number of years. And so a lot of people saw that as paving the way for kind of a partial student loan forgiveness, this year or next. And so I do think that's somewhat likely, that at least that partial one that Biden supports, not the complete one. And then looking out further, it's the infrastructure one. That's the one that I have lower conviction that they could pass. Now, I do think they probably will pass something, but there's not a lot of wiggle room in the Senate. And so overall, that could affect inflation expectations. And so if they pass that, my overall inflation expectations would be higher than if they don't pass that. My overall viewpoint is towards a higher degree of inflation here, but the magnitude will in part depend on what they're able to get through Congress.
Well, if other countries are going to keep devaluing their currencies, and that's going to leak into the global supply chains, and China is going to stockpile commodities like crazy, all of that's going to get into the global supply chain and force costs higher, and that's going to create higher inflation too. So the US's imports are where it's going to be affected, because the US doesn't actually manufacture a lot of things anymore. A lot of stuff that says it's made in the USA is actually just assembled here. So a lot of imports are going to get more and more expensive, even if the dollar doesn't collapse, because of all these other countries are devaluing their currencies.
Yeah, I agree.
Well, Lyn, I want to thank you so much for your time today. I've kept you for over an hour. We've had an excellent discussion, covered a lot of different topics. We talked about all the major economies, commodities, gold, a lot of great insights in there. So thank you very much for your time today. And if my listeners want to check out your free newsletter or your paid newsletter, how did they do so?
That's at lynalden.com, and they can start off with the free stuff and see if they like it. So thanks for having me.